Hello and good evening to all the participants. How are you all? I hope you're all fine and practicing a lot to pass the exam in very first attempt and score good marks. So let's start with today's work so that we can finish in time. So students, in the last session, we were doing with impairment of assets, and we will continue with it in the beginning of today's session. So let's start with impairment of assets. We'll be doing question number 27 first in respect of impairment, right? So first, please read the question 27 and then we will start. So I'm giving you a minute's time to read it. So please read it. Okay, students, let's start with the first question. Question number 27. What does it ask? It's asking about at what value should the plant appear in Matrix statement of financial position as at 31st March 2004. So let's do a working in order to know this. So the plant was having a carrying value of 248,000 on 1st of April 2003, right? So first we will deduct depreciation out of it in order to arrive at the carrying value on 31st March 2004, right? So depreciation is being charged at 12.5% per annum on reducing balance basis. So you'll arrive at the carrying value. And as I said, the carrying value of the plant should not exceed the asset's recoverable amount. Recoverable amount means the benefit which has to be received from the asset. We cannot show the asset at a value which is more than the benefit to be received from the asset. So we will compare the carrying value with the recoverable amount, right? So let's start now. So the first step of ours is to calculate the carrying value and then the recoverable amount for comparison. The carrying value on 1st of April 2003 was 248,000. We will deduct depreciation for the year from it, which will be 248,000 multiplied by 12.5%. This makes 31,000. Now deducting the depreciation brings the carrying value down to 217,000. Now this is the carrying value. On 31st of March 20x4. Now we'll compare this carrying value with the recoverable amount. So you should remember what is recoverable amount. Recoverable amount is higher of the assets fair value less cost to sell and value in use. So you are given with the value in use in this question. See, value in use is the present value of the cash flows that will arise in future by using the asset. So this present value working is showing you the value in use of the asset. So the value in use of the asset is 214,600. Okay. Okay. And further it says that on 1 April 2004, Metric had an offer from a rival to purchase the plant for 200,000. So maybe its fair value is 200,000. So now what's the higher amount? The higher amount is 214,600. So the recoverable amount is 214,600 in here. So I am shading it as red. Okay. So the recoverable amount is found to be 214,600. So now compare this recoverable amount, this red amount, with the carrying value. Isn't the carrying value higher than the recoverable amount? It is. So what you have to do, you have to reduce the carrying amount by the impairment loss, which will be recognized in the profit and loss account. So you will reduce the carrying amount by the impairment loss, which is the difference between 217,000 and 214,600. So this makes 2,400 impairment loss. And now the value that appears is equal to recoverable amount. So it is no more overstated now. So earlier the asset was overstated at 217,000. So we bring it down. We bring the carrying value down to 214,600. So whenever the carrying value exceeds the recoverable amount, we will bring the carrying value down. Now this gives you the carrying value after impairment. To be reported in the profit and loss account. So the correct answer is $214,600. This will be showed in the financial statements for the property, plant and equipment, for the plant. Okay. So that's the answer. Okay, so let's move ahead now. Students, let me tell you about today's topic as well. So what topics we are going to do today? We are going to do complete this impairment thing, then a bit about IS 37, and then consolidation and interpretation of financial statements along with associates, right? So these will be the things going to be done today. Okay, next question. This is a case type question from 28 to 32. You can go through it. I am giving you a 2-minute time to read it out. So you can please read it once first, and then I will tell you how to attempt it. Okay, students, let me tell you the story in the first paragraph. So the story was that Aphrodite purchased a machine on 1st July 2003 for 80,000, and then depreciation was charged over 10 years on it on straight line basis, right, and on time apportionment basis, and the machine was revalued on 1st of July 2004, which means in 1 year's time. So after 1 year, it was revalued to 81,000. So this is the basic story about the machine in the first paragraph. So first of our questions are based on paragraph 1. So let's first do those questions. Okay, question number 28. Question number 28 is asking about what is the depreciation charged to Aphrodite's profit and loss account for the year ended 31st of December 2004. So this is what required. Okay, so let me tell you the depreciation now. So they are talking about the depreciation in 2004. Now what happened that during the year in between, after 6 months, the revaluation occurred, right? So if the revaluation occurs in between the year, what happens that the first 6 months depreciation will be calculated on the historic cost, which is 80,000, right? And the rest of the 6 months depreciation will be calculated on the revalued amount. So we have to calculate depreciation for the year in two pieces. So let's do it first on the for the first 6 months from January till June. So first 6 months depreciation is going to be calculated on 80,000, as in the first 6 months the revaluation was not conducted. So take the depreciation for 6 months, which will be 4,000. Then the revaluation occurs on 1st of July 2004. So the next 6 months depreciation will be on the revalued amount. So next 6 months depreciation will be on 81,000, right? So this revaluation occurs after 1 year's time, right? So now the revised amount 81,000, this will have to be depreciated over 9 years, as 1 year has already gone. So now the depreciation will be calculated on the remaining life. So we'll divide by the remaining life, and again for how many months? For the 6 months time. So now it is 81,000 divided by 9 into 6 by 12. So this gives you 4,500. So the full year depreciation totals to 8,500. So that's our answer. So the correct answer is D. Okay, one of the participants asked me about the difference between the carrying value and the value in use. So let me tell you about the difference between the carrying value and the value in use. What is the difference? So it is like this. Carrying value is let me give you the definitions. Carrying value is the amount at which we report in the financial statement. It's the book value. The book value, net book value, carrying value, these are all same. So carrying value is cost or the revalued amount, or the fair value you can say, minus accumulated depreciation and accumulated impairment loss. Right? So this is the definition of the carrying value. Now, what is value in use? Value in use is the present value. Present value means you have to discount it. You have to calculate a present value by multiplying the cash flows with 1 plus r to the power minus it. The present value of future cash flows. From continuing use of the asset. Right? And from sale of the asset, the sale of the residual value at the end of useful life. Right? So value, what is value in use? Suppose I have an asset, the life of which is 4 years remaining. Or we can take an example in question number 27, as we did in question number 27. See what they did in 27. They have calculated the present value. The remaining life was 3 years, and what they did, they multiplied the net cash flows for the next 3 years with the present value fraction to arrive at the present value. So this is the cash flow that will occur in the future if you use the asset for the next 3 years. And the present value of these 3 ticked items is this. So sum of these is value in use, and which is 214,600, right? Obviously 120,000 should have been multiplied by some factor to arrive at 109,200. And this 39,000 includes the residual value as well. This 52,000 includes the residual value, and obviously the present value of residual value has also been taken. So this includes the normal cash flow and plus the residual value, both, and its present value is 39,000, right? So that's value in use. So carrying value is entirely something different. Carrying value is book value of the asset, right? Okay, so that was a detail about carrying value and value in use. Okay, let's move on to the next question. We have to do consolidation also as well today, and in some part of interpretation as well. So let's move on to question 29. Now, in question 29, they are asking about, there are indicators for impairment like decline in market value, obsolescence, damage of assets. These are all indicators, right? So what they're asking over here, that IS 36 impairment of asset contains a number of examples of internal and external events which may indicate the impairment of asset, right? For example, a car undergoes an accident. So due to the accident, this is an indication, physical damage, the value of the car goes down. And obviously impairment, what is the meaning of impairments? The meaning of impairment is damage, decline in value. This is what known as impairment. So out of these, what they asked, in accordance with IS 36, which two of the following would definitely not be an indicator of impairment? You have to tell which ones are not impairment, not indicators of impairment, not be an indicator of potential impairment of an asset. So see, a reduction in Aphrodite's cost of capital is not an indication for impairment. Why? Because if the cost of capital decline or the interest rate decline, the present values will increase, right? And also if interest rate fall, the fair values of assets increase. So if the values increase, so you will be able to recover the cost of the asset. So the impairment won't take place, right? Secondly, adverse changes in economic performance. Yes, adverse changes in economic performance of assets means you won't be able to recover it. So it's an indicator. A significant change in technology, like they are telling about that obsolescence. Things are getting obsolete means, okay, the machinery will no more be used or will be less used if products are getting obsolete. So this is also an indication for impairment. And then they say the carrying amount of an entity's net assets. Carrying amount means the book value of net assets of an entity are below the market capitalization. Market capitalization means the stock market value. So the company's value in the stock market is high. So if it is high, then the book value means that the people believe that the book value of the assets will be recovered by more than the book value amount. That's why the market value is high. So this is also not an indicator for impairment, because this shows that the value of the assets are higher in the market than what are being shown in the financial statements. Okay, and then an expected, obviously we have got the two, an expected fall in the market value. Obviously market value fall indicates that we may not be able to recover because the market value are falling. So this is also an indicator. So the correct answer is A and D. These two are not indicators of impairment. Okay, let's move to the next one. What is the total impairment loss associated with Aphrodite's machine at 1st October 2006? So now they are talking about somewhere later on 1st October 2006. So what happened, that they revalued the machinery, the same machinery we were talking about earlier. So when they revalued the machinery, the machine was appearing at fair value on 1st of July 20x4. So they brought the machinery to 81,000, right, which was its fair value. Now The new date about which they are talking now is 1st of October 2006. Means from this date, 1st July 2004, the revaluation date, we are talking about a time after 2.25 years. We are now talking about the value after 2.25 years. So first we will calculate the depreciation for the 2.25 years before we move on to further the impairment loss calculation. So every time we need to calculate impairment, first we will calculate the carrying value and then compare with the carrying value with the recoverable amount. The first step is calculating carrying value. 81,000 was the carrying value in 2004, 1st July. Now deduct the depreciation for 2.25 years. So the depreciation for 2.25 years will be calculated on the revalued amount, 81,000. What was the life remaining when the revaluation took place? 9 years. Revaluation took place after 1 year time. So remaining life was 9 years. And now we need to have a depreciation for 2.25 years. So multiplied by 2.25. This gives you a depreciation $20,250. After deducting this, we arrive at the carrying value. Now, this carrying value you are watching on the screen is on 1st of October 20x6. Now, same thing. Now we will calculate the recoverable amount. So recoverable amount is higher of fair value less cost to sell and value in use. So let's move on the question to see what is the fair value less cost to sell and the value in use of the asset, the machine. So I'm moving back to the question. Let's check. So I'll be highlighting, be marking with red ink the important figures. See, carrying machine value is given 60,750 as we calculated, right? And then the fair value is 90. Sorry, the machine could be sold now for 45,000, and dismantling cost would be 2,000. And what they say about the value in use? The value in use figures of 38,685. Right? So the fair value is 45,000 and we will deduct the cost to sell. So 45,000 is the fair value. And we will compare the fair value with 38,685, which is the value in use. So let's do it. So the fair value is 45,000 and the cost to sell is 2,000. This gives you 43,000. Then the value is 38,000. Value in use is 38,685. So the higher of both of these is 43,000. Right? So now let's compare with 60,750. The fair value less cost to sell is 43,000. Right? So now the carrying value is higher. So you have to record an impairment loss to arrive at the carrying value after impairment. So what's the impairment loss? The carrying value now is going to be 43,000. We have to bring it down. We are overstating the assets value, 60,750. We have to bring it down to 43,000 to report it correctly. So what is the difference? The difference is the impairment loss. 17,750 is the impairment loss. So the correct answer is B. Now, the next part. Okay. So please read the question in a minute's time. Then I will tell you the answer to this question. So what they are asking, the accountant has decided that it is too difficult to reliably attribute cash flows to this one machine, and that it would be more accurate to calculate the impairment on the basis of the factory as a cash generating unit. In accordance with IS 36 impairment of assets, which two of the following? So they are asking about which two of the following are true regarding the cash generating units. What is a cash generating unit? Cash generating unit is defined as a smallest group of assets. CGU is the short form of cash generating unit. It is the smallest group of assets in an entity that can generate cash independent of other groups in the entity. So it's the smallest group of assets that can, without help of other assets or group of assets, generate cash independently. It can generate the revenues independently in the company. So there can be many small groups which will be generating revenue for the company. And if I show you by using a diagram, suppose this is a company, this is an entity, right? And there are many groups in the company, small groups. One group is having 4 assets, and by using just 4 assets, it can generate revenue. Some groups are of 5 assets. They have 5 assets, a machine, a car, likewise, and they are generating revenues, their own revenues. And they don't need the help of the group of the 4 assets, the other group. So these are all, there are 5 groups in a company, small groups, which can generate cash flows independently, right? So this one is correct. Smallest identifiable group of assets for which independent cash flows can be identified, right? So D is correct, and E is also correct. Assets in a cash generating unit should never be impaired below their recoverable amount. So obviously, when do impairment take place? When do impairment take place? When the carrying values are higher, and what they say, okay, we cannot bring it down below recoverable amount. So you cannot bring the asset down below recoverable amount unnecessarily. So impairment will only take place when the carrying values are higher. So you cannot bring the carrying values down when recoverable amounts are higher than carrying value. You can only bring it down when the recoverable amount are lower. So that these two are correct. So D and E is the correct answer. Okay, next, this one is an important one, a very important question of cash generating unit. Please note down very carefully. First, please go through it. Please properly read the question, then I'll do it. First of all, now they are talking about a cash generating unit. And how many assets are there in the cash generating unit? A building, then a plant and machinery, then goodwill, and net current assets. Probably net current assets will be inventory, receivables, and these type of things. So there is a group of asset. The group of asset becomes a cash generating unit. Now, has impairment taken place or not? So impairment has taken place because the carrying value is 1170. And what is the recoverable amount? Recoverable amount is 950. So this amount, which I'll be marking in blue in a short while, is 950,000. This is the recoverable amount, right? And the carrying value is more than this amount. So the impairment loss has taken place. So what is the impairment loss? It is 220,000, first of all, right? So please remember the sequence. How am I doing it? First of all, what I did, that I will pick the carrying value of the cash generating unit, which is 1170. And what is the recoverable amount? Recoverable amount is, no, higher of fair value less cost to sell and value in use. But over here they have given it 950,000. So the asset is overstated by how much? This is the impairment loss. So I have to reduce the value of the cash generating unit by 220,000. So there is a 220,000 impairment loss. Now the next question is that 220,000 is the impairment loss. I have to show the assets in the balance sheet separately. Building will be shown separately, plant and equipment will be shown separately, goodwill will be shown separately, net current assets will be shown separately. So I have to allocate the loss, divide the 220,000 loss to various assets. How will I do that? That's important. That how will I divide the loss amongst the assets? So what's happening, that I have a building and the book value of the building is 500, right? Then I have plant, right? I have two types of plant. One that is damaged, make it separate. The damaged one is of 35,000, and one is the others are of 300,000. Right? So there are two plants totaling 335,000. They have mentioned over here. You can read the bracket adjacent to the plant and equipment. Okay. Which shows that there is a plant of 35,000 which has completely been damaged. Okay, then it's goodwill, and then it's net current assets. So goodwill amounts to 85,000 and the net current assets are 250,000, right? And all of these total How much? 1170. Please follow the sequence that I use. First, I have already calculated impairment loss. Now I have to allocate this loss to various assets over here. This is the carrying value amount now. Now I'll be allocating the impairment loss to various assets. First, to which asset? First in the sequence will be impairment loss will be allocated to the individual asset whose carrying value I already know. Individual assets whose recoverable amount I know. First loss will be allocated to the item in the cash generating unit whose recoverable amount is known. So which item's recoverable amount I know? The plant which is completely damaged. I know its recoverable amount is 0. Right? Now one more thing you need to know. Why are we using this cash generating unit? Why are we not calculating the losses separately? We are not calculating losses separately because we cannot calculate the recoverable amount separately. The recoverable amount 950,000 is belonging to the whole group of asset, right? So if I can calculate recoverable amount for an individual asset, I will first treat it separately. So I do know that one of the machine of 35,000 is completely damaged. So what I'm going to do, I'm going to first deduct 35,000 from there. So let me deduct 35,000 from there. Now the total amount I have to deduct is 220,000 from here, right? And then I will get a revised carrying value after impairment. So this is gone. This asset is gone. It is now 0. The revised carrying value is 0. Then that once I have calculated impairment loss for an individual asset, then I will move to the remaining asset. Now what remaining assets are left? Next point. What remaining assets are left? So other than the damaged plant, we have the building, others, goodwill, and the net current assets. So now I will treat the cash generating unit, which includes these 4 items in the red circle, right? So the first turn will be goodwill. The first turn will be of goodwill to allocate the impairment loss. So first of all, I will deduct the impairment loss from the goodwill, and I will try to deduct the maximum amount from the goodwill. I try to write off the goodwill as much as I can, right? So, right. Can I deduct 85 from the goodwill or not? I have plenty of loss. I have 220. So I can easily deduct 85, right? So I have deducted maximum loss from there and the goodwill gets 0. Now, this is also 0. So 2 items gone. Now, what items are left behind? So now the items left behind, you will be seeing in green color. You have building, sorry. You have the building, you have this others, and you have this 250. Now, once the asset is gone, the plant is gone, once the goodwill is gone, now 3 items are left. Now I have to allocate the loss proportionately. The item having the higher carrying value will get more loss, and the item having the lower carrying value will get lesser loss, right? So allocated according to the carrying values, the value of the assets, carrying value of the assets. Now remember one thing, that what they say, that net current assets are already at recoverable amount. They are already at recoverable amount means I cannot allocate any loss to it anymore because it will be reduced below its recoverable amount. So as said earlier in the previous MCQ, we cannot reduce the book value of the asset below its carrying value, below its recoverable amount. Sorry. So over here, the recoverable amount is 250. So no impairment loss has occurred on this non-net current assets. So always check that before you allocate a loss to the asset, to an individual asset, you should check that the carrying value will not be reduced if the recoverable amount is higher, right? So the recoverable amount is 250. So I cannot allocate any loss to this asset. So I will not allocate any loss to this asset. So what happens? Take it 0. No loss to be allocated to this, and this remains at 250. So this is also done now, right? So first I allocated loss to the asset whose recoverable amount was known and I knew it was damaged. So I write it off first. Then I go to the goodwill, fully write off. Now I check that any asset having fair values or known recoverable amounts that have not been impaired. So that also done. Allocated 0 to it. Now what two items are left now? Two of them are left. And that two will come in purple. So one is the building and the other is this 300 item, others. I don't know the recoverable amount of these two items. Nowhere in the question their recoverable amounts are given. Only the carrying amounts are given. I don't know their fair values, that what are the fair values. Means the remaining loss belongs to these two items. So now I will allocate the loss to these two items. And how will I allocate this? To first total them, total their book values, total the amounts in the purple circles. So that's 800. So what I will do, that deduct 85 and 35 from 220. So the loss was 220, out of which allocated to the damaged plant was 35 and allocated to the goodwill was 85. Now how much is left? The remaining amount of loss that needs to be allocated is 100. So 100 needs to be allocated. So now I will be allocated 100 to these two items. 100 is the loss multiplied by 500 is its own carrying value divided by the total of both the assets carrying value. And then again 100 multiplied by the carrying value itself, 300 of the others, and divide by 800. So what we'll be doing that we will add the carrying value for all the assets remaining and then divide the carrying value with the total to get the proportion and multiply it with the impairment loss that's remaining. So doing this, I get the impairment loss that will be allocated to both the items. So now this makes 62.5 to the building and 37.5 to the other plant and machine. This is how it is done. And now 500 minus 62.5 loss, the building comes up to 437.5 and the other plant is reduced from 300 to 262.5. And now see the columns total will get 950. See, so they have reduced to 950. Now what the question asks about? The question is asking about, so I've taught you the whole process. So what the question is asking about, that in accordance with IS 36 impairment of assets, what will be the carrying amount of Aphrodite's plant and equipment when the impairment loss has been allocated. So after allocation of loss, what remains? It's 262.5. So the correct answer is 262.5. Okay, so that's end of our impairment chapter. So the remaining questions you can try yourself, which are remaining in this section of IS 36. Now let's move on to IS 37. And after a few minutes and doing a few questions of IS 37, we'll be moving on to consolidation and interpretation of financial statements. So let's move on. If you need to copy it, I'm waiting for a minute. If anyone wants to copy or note this down, I'm waiting for a minute. Okay, so let's move on to the next section, IS 37. We'll take a few important ones from here as well. So we will start with question number 36. Okay, that's the question number 36. Please go through it. Okay, students, before we go on to IS 37, let's have a prayer break first, as we do in all our sessions. So we will be taking a prayer break for 15 minutes, and then we will commence with the IS 37 section, right? So please be back in 15 minutes after offering prayers and taking a brief refreshment. So see you after the brief break. Okay, students, let's resume. And now we will talk first on IS 37. Few minutes we'll give to the IS 37, and then we'll move on to the consolidated financial statements and interpretation. So let's start with question number 36. Please read this question 36. Let me tell you a bit about IS 37 first. It is mostly it involves accounting for liabilities, IS 37. So now, when do we record a liability? Just I want to give some general concepts because we don't have that much time that we go in very much detail, but I'll give you a very important general concept about the liabilities. Look, we will record liability when it is not possible for the entity to save itself from settlement. From settlement means from payment or whatever they have, the resources they have to remit to some other party. So suppose you enter into a contract, and by merely entering into a contract, you may not get bound to make payments. Like for example, you enter into a contract and you do not receive goods from the seller of goods. So will you record a liability? By just entering into a contract or by just presence of a law, you do not get bound. In order to get bound, there should be a binding activity. Binding activity means that after entering into a contract with a supplier of goods, he dispatches you some goods. Now, once you receive goods, now you can't tell him that I won't pay. Now you have to record the liability. Likewise, you enter into a contract with the electricity supplying company and they have not yet delivered you any service or they have not yet provided any electricity to you. You won't record any liability until now. Once they provide you electricity and the electricity gets measured that this much of electricity has been provided to you, now you are bound to make them payments. So after you enter into a contract or after a law has been made, everyone do not get bound until a binding activity occurs, right? So the important thing is there should be a contract or there should be a statement or recent practice or a law through which one party will bind itself, but he will not bind himself until unless the binding activity occurs. So one of the person said, a director of a company, that I will clean up all the pollution that occurs in the surrounding of our factory. So now this statement is creating a contractual obligation, or sorry, it's creating a constructive obligation, and he's telling that we do bind ourselves that we will clean the surroundings if pollution is created. But there is a question of mine that do the company's factory pollute its surroundings? So the production process is very safe, suppose, and the production process is so sophisticated and secured that it do not pollute the environment. So just his statement will not make him record a liability. Statement did bind him, but he will not record a liability until the pollution occurs. After a few years time, some pollution occurs and it destroys the surroundings. Now he is bound to record a liability. Agreed? So first of all, the entity will bind itself either through a contract or through a law or through a recent statement or a past practice, and then a binding activity will occur in the future which will make the company record the liability. This is the main theme behind this thing. So the liability recognition. So liability is a present obligation. Obligation means now you cannot save yourself from making payments or settling those liabilities. So at that time you will record the liability. Now what this question says? Now this question says that on 1 October 2003, Explorer commenced drilling for oil in an undersea oil field. So drilling has begun. Drilling has started. The extraction of oil causes damages to the seabed. Now, extraction of oil causes damage to the seabed. Means the more the oil they will take out, the more the damage will occur. So once they keep pulling out more oil, extracting more oil out of the oil field, the more the damage will take place to the seabed. Right now, what happens? The restoration cost is 10,000 per million barrels. Per million, it's 10,000, and they have extracted how many? Till now, they have extracted 250 million barrels. So now there is a question: can this company Explorer avoid itself from paying 10,000 per million barrels for these 250 million barrels? It cannot. So it has got bound and it has now to record the liability. Okay, now the second thing, second paragraph. Explorer is also required to dismantle means to remove and separate all the equipment from the seabed. Dismantle means to separate out, and it's an opposite of assembling. Assembling means to join, dismantle means to separate it out. At the end of the 5-year license, so after 5 years time, it will have to dismantle the equipment. So now there's a question: suppose that Explorer has not installed the equipment to drill out the oil, will they have to dismantle it? No. Now, why the company gets bound to dismantle it after 5 years? Due to the installation of the equipment. So it is the installation of the equipment and fixing of the equipment which will make them dismantle it. So have they installed it or not? Yes, they have installed it. They have started drilling it out. So the equipment should have been installed on 1st of October 2003. So they have committed 2 liabilities. One liability for dismantling and the second for restoring the seabeds, right? So this is what important. Now, remember one thing more in mind, that when they will make the payments will take place in future, in 5 years time or after 1 year's time. So if the payments take a long time, you will have to calculate present value for those payments. So over here, what happens, that 5-year license they have taken and they have to dismantle after the end of 5 years license time. Then they will again get a license for the next 5-year period. So you will have to calculate the present value of this 30 million amount, the dismantling cost. So you will multiply the 30 million with 68 cents. So every $1 is equal to 68 cents now. Every $1 that will be paid in 5 years time is right now how much? It is valued at 68 cents in terms of present value. So now what shall be the liability? Now what are they asking is, what is the total provision which Explorer would report in its financial statement of what date? 30th September 2004. At what date did they start drilling? On 1st October 2003. So this is after 1 year's time. They are talking about 1 year's time. Okay. So let's move ahead and get the calculations. First of all, the provision for dismantling the equipment. This will be initially recorded at present value on 1st of October 20x3, because when did they get bound? Once they install the equipment, now they cannot save themselves from making a payment. So 30 million will be the payment after 5 years time. But you have to record that if anyone asks you for the payment immediately on 1st October, how much will you pay? You will be just paying 68 cents right now. You won't be paying the interest. That's what I mean to say. So this is discounting. So the liability will be recorded at 0.60. Now what happens? They are asking for you to calculate the liability on 30th September 2024. So in 1 year's time, what happens? 1 year has gone. You will have to unwind the discount. You calculate the present value, so you reduce the amount. Now when the time passes on, again the liability component will increase with the amount of discount. Will keep, first you remove the interest and now you again add back that interest. So initially you discounted the cash flows, now you will unwind it. Unwind means you will again add back the interest to it. So now how much interest should be added? Always the interest will be applied to the balance outstanding. What's the balance? 20,400,000. Multiply this by the rate. They have given you a rate, so you will multiply that with the rate, which is 8%. Multiply 1.08. So this increases by 8%. So one year's interest gets added to it. Multiplied by, if you multiply by 1.08, you will get the overall liability just multiplied by 0.08. So you add the interest to it. So 20 million multiplied by the 8% interest for 1 year. This added, and now the liability sums up to. So whenever you record a thing at present value, after passage of some time, you'll have to add interest to it, right? So now you add interest to it, 20.4 million plus 1.63. So this makes 22.03. This is the liabilities value now. Balance on 30th September 20x4. So remember, once you record a liability at present value at a particular time, after passage of time and the reporting date comes, you have to add interest again to it, so that the amount again keeps on creeping up, and after 5 years it reaches 30 million. So now next year's interest will be applied to 22.032 million, 8%, and then to the larger amount, and it keeps on growing, and it will make up to 30 million after 5 years time. Now the second liability is of provision for cleaning, restoring the seabed. So this they have to do every time, every year. So over here you don't have to calculate present value. Just what happens, that 250 million barrels they have taken out, and for each barrel they have to pay $10,000. So 250 million into 10,000. They are now liable to incur a cost of 2.5 million in here. So now what's the total liability including both of the obligations? This makes 24.532 million. So that's the correct answer, and it's B, the option B. Okay, let's move on to the next question now. Now this is a case study, an important one. Please go through it. Please read this case study out. Take a 2-minute time to read it out. Three types of liabilities are involved in this case study. Yeah? 3 types of liabilities are involved. Let me mark them. Then you read it out so that you can effectively read it, because you have less time. One of the liability is that one of their employee has sued the company. for some workplace accident. The second one is the warranty they give to the buyers of the machine they sell. And the third one is restructuring. So these are the three. First one is employee accident, sued by the employee. Second one is warranty agreement. They have to meet the warranty claims. And the third one is restructuring agreement. Okay, please go through the question. IS 37 in the day 2 document. Huh? Okay. Question 37 is a general one. Which of the following are outlined in IS 37 provisions, contingent liabilities, and contingent assets as criteria required for recognizing a provision? There is a paragraph in IS 37. Its number is 14. So it requires a criteria that when you will recognize a provision. So there are three requirements. What are the three requirements in it? Is one of them is that present obligation has occurred. Present obligation exists. Like I explained a few minutes ago, that how do the present obligation exist due to the binding activity plus the contract or plus the law. Second, settlement is probable. Settlement is probable means that the payment will take place, more than 50% chance. And third, measurement is reliable. You can calculate the amount, no need to guess them. If you have to make guessworks, you cannot record the liability. These are the three items. Now, which ones you find over here? See, this second item is not there. It is possible that an outflow of resources will be required. It is, the word should be probable over here. The word here, over here should have been probable, which matches with this item. Settlement is probable. So the word is possible. Possible means less than 50% chance. So this is not there in IS 37. These two are there. Present obligation is, and the reliable estimate can be made. So the right answer is 1 and 3. C. Okay, let's move ahead. This was a simple one. What amount should be recognized as a provision in respect of workplace accident claim in the year ended 31st December 2004? Okay, let me tell you a rule. first before going on to this. See, we have to estimate amounts. When you are estimating a liability, when making an estimate, first you need to know that whether that payment will occur only once or it will occur again and again. Like in case of warranty provision, the warranty claim will occur again and again, but this employee accident will not occur again and again. It has occurred just once. So what we need to know first is that whether there is a single obligation or a large number of settlements. In case of warranty, what happens that in this question, there are two situations. One is the case of employee accident, and the second one is warranty provision. So what happens that in case of employee accident, what they will do? In case of employee accident, the liability that will be recognized will be the most likely amount. Most likely means the probability of which is highest. The probability of which is highest. Amount with highest probability. And the warranty provision will be recorded average because again and again it will occur. So over here you have to calculate the average. It won't occur only once. So over here you won't take best estimate, you will be taking an expected value. Expected value is an weighted average. Right? So now the question number 38 and 39. This covers this diagram. So my diagram covers these two questions. Over here, just check what happens that in case of employee obligation, employee accident, how much amount the company, how much is the chance of payment of 2 million? It is, so see, first question is whether the company is bound to make the payment or not. Yes or no? Answer yourself. Yes, they have to make a payment because the accident has occurred and company cannot save itself. Now the next question is that once the company has to record the liability, so at what amount will it record it? So 1 million, 2 million or 3 million. There are three possibilities. So you will see that the most likely payment is of 2 million, 60% chances. So this will be recognized because there's a single obligation. So the correct answer is 2 million in this case. Nothing to do, just you have to select the amount. So the very easy one. You didn't have to do a lot of calculations in this. So if you get a lot of these type of questions and you can make it, you can save a lot of time. But things are calculated in the exam. The question are pitched according to calculation of time as well. Okay, so the correct answer is, sorry, it's 2 million. It's C. Now, read this 39th one. What amount should be recognized the warranty provision in the year ended 31st December 2014? So over here, if you see the question, warranty provision. What they say? They say that two types of faults can occur. One is minor fault and the other one is major fault. So there are two possibilities. The chances of minor fault is 6% and major fault is 8%. And the cost of repairing is $30 for the faults. So $30 is the for a minor fault and $100 is for a major fault. Right? Minor fault will result in a $30 repair. So now what will be the cost? So the cost depends on the sale. The more they sell, the more will be the liability. See, if they have not sold anything, they won't record the liability. The obligation, the binding activity is due to the sales. So 100,000 is the sales. Out of 100,000, 6% is the chances of major faults. So what working will take place over here? Let me do the working. See, expected value is average. See, 100,000 units have been sold. And what are the chances of major faults? 6%. And each major fault will cost the company how much? $100. And out of the 100,000 sales, 8% is the chance that there will be some major faults. And what will be the cost of it? The cost of it will be $30. So in expected value, we calculate two costs at their own probabilities. We have multiplied by 6% and 8%, and we will add both of the cost to arrive at the answer. So I have used both the items, major faults also and minor also, because both of these will occur several times. So you have to take an average. So the average cost is the sum of these two, 8,40,000. The correct answer is $840,000. Okay, let's move on to the next question. Question number 40. This is the last of our IS 37 question we'll be attempting. Okay. restructuring provision. A very important concept here. In the restructuring provision, what do we mean by restructuring? By restructuring, we mean that we are changing, the company is changing the method of producing, like they are moving on from manual production to automated production. So they are changing the method of producing, or they are closing some branches, they are terminating some employees. So they are reducing something or changing the way of doing things. So they are, suppose, making hundreds of employees redundant. So that's a restructuring, delayering, downsizing. These are all restructuring items. Giving golden handshake payments, these type of things. Then closing branches, shifting from one place to another. This is all restructuring. Now, due to this, various expenses occur. Right now, if a restructuring take place, the expenses that will be recognized in the restructuring provision should have two characteristics. Remember those two characteristics, very important. In order to include an expense in a restructuring provision, the expenditure shall be directly related to the restructuring. For your convenience, I will use the word connected to discontinuation. Usually in restructuring, there will be a discontinuation. Like if they are switching a branch, so they will be discontinuing one branch and going on to another. They are, if they are making some employees redundant, so they are making that employee continue his work. If they are leaving a branch and they are leaving a landlord and telling them that we won't continue the tenancy agreement with you, so they are leaving a premises. So usually it involves terminations and discontinuation. So expenditure shall be connected to discontinuing something. Plus, and means both conditions should be present. Only one condition is present, you won't include that expenditure in the restructuring program. The second one is shall not be connected to continuation. Shall not be connected to the continuing activities of an entity. Now see, suppose that a company has decided to close a branch in one city and open a branch in another city, or discontinue an operation in one location and continue at another one. So what they will do, they will market it, the new location. So why are they marketing the new location? Due to discontinuation or due to continuing somewhere else? So due to both. So these two conditions not met, because this marketing is due to continuing somewhere else, so they cannot include it in restructuring provision. This will be recognized when the marketing takes place in future. So it won't be included in restructuring provision because it is connected to continuing activity. Now suppose they make some employees redundant. So what happens? Redundancy is restructuring, connected to discontinuation, and those employees will not continue. So nothing to do with continuing operations. So both conditions are met. So this redundancy payments are part of restructuring provision, right? So both conditions should be met. If you suppose see a payment occurring due to continuing business activities, they will never form part of restructuring provision. So now check what three expenses did they give, and out of which what expenses will form part of the restructuring provision. Just check. These are the four items. These are the three items they have given: 1.2, 0.8, and 2 million. Now, which one? This is right. Redundancy is connected to discontinuation and not connected to continuation. Staff relocation. If you relocate a staff, what will that staff do when they move somewhere else to a new location? They will work for the company. They will continue. So this cannot form part. This is connected to continuation. And investment in new systems. Why do you invest in new system? To continue the business. So this will also not form. So this one is the only item 1.2 million. The correct answer is 1.2 million. And the option is A. Okay, so that's IS 37. Now let's move on to the consolidation section. Let's start with consolidation section. The group financial statements. So now we are watching. Okay, these sheets will be handed over to you tomorrow. So these Excel sheets will be uploaded on this webinar section tomorrow. First, you have got the day 1 and 2 work, right? So now day 3 and 4 will be given to you tomorrow. Okay. So students, when will you consolidate financial statements? So consolidate financial statements prepared when the company has control, when one company exercise control over the other. The investor exercise control over the investee. So in this case, the control depends on voting rights. Whether it will be able to control or not, it depends on voting rights. So this 75%, 30%, and 2% is voting rights. So in case of the pink circle, there is a control of P company over subsidiary company, of S company. S company and P's financials will be consolidated. In case of A company, the green circle, 30%, P company, if having more than 20% voting rights, they can appoint some directors, but they cannot fully control all the decisions and make all decisions in favor of themselves. So A company is an associate, it's not a subsidiary. Their financial will not be consolidated, equity method will be. And in case of 2% holding, in K company, P company will not be able to appoint any directors. It's a very little holding. So this will be accounted for in accordance with IFRS 9, if you remember. Financial asset at fair value through profit or loss, and or financial asset at fair value through OCI, if they make an irrevocable election. So the accounting for this has been described down in some colorful diagrams. So you can read those diagrams to get a summary of the concepts. So please go through it, these diagrams for a few minutes, for 2 minutes, and then I will start doing some questions related to consolidation. Okay, participants, one thing I want to tell you that when I'm solving questions and delivering lectures, it is very difficult for me to answer your questions immediately. So I will answer the questions. I will take a when I will take a 5-minute break. I will answer your questions, right? In some time. I do try to simultaneously do it, but it gets very difficult because I'm writing on the Excel sheet as well. So I can't write on the and read on both of this the question answer section, and over here as well. So I'm really sorry if you had to wait. So definitely it's really very difficult to wait for your questions. So I'm extremely sorry, but I will answer to your questions when I get time, right? Okay, students, let's start with the consolidation section now. You would have read with the accounting treatments. So the question is Perkins now. We are going to start now. It's Perkins. Okay, student, this question Perkins is regarding subsidiary which has been sold. So I've started with disposal. The reason behind is that usually people do uh, prepare questions which involve acquisitions. They don't normally uh, reach the disposal questions. So I'm focusing more on disposal questions. So disposal question will also involve some part of the acquisition calculations as well, right? Okay, so let's start with this question Perkins, and let me tell you a few things that when we acquire a subsidiary company, what happens when a subsidiary company is acquired? Consolidation consolidated financial statements will be prepared. Right now, what do we mean by consolidated financials? What procedures do we do? So the procedures involve, I'm giving a brief summary. The procedures involves calculating goodwill and including it in consolidated financial statements. Second, calculating NCI and including it in consolidated financial statements, right? And then including fair value of assets and liabilities of subsidiary company in consolidated financial statements. Do you agree to this? And these are known as net assets. So mainly these three items are included in the consolidated financial statements. So we include three items in the parent's financial statements: goodwill, NCI, and the net assets of the subsidiary. And then with passage of time, what happens? That the net assets of subsidiary keep increasing. When the subsidiary company earns profits, the net assets of subsidiary keep changing. And therefore, the consolidated financial statements are adjusted for it. Now, what happens when a subsidiary company is sold? Suppose we sell shares in a subsidiary company and we lose control. So we sell all of the shares and we lose control. What will happen? If all shares held in a subsidiary company are sold, what happens? You will stop showing the net assets in subsidiary. S stands for subsidiary. Subsidiary is goodwill and NCI. So you will stop doing this. You will cease to show net assets in subsidiaries, goodwill, and NCI. So what happened? That you will make an entry. When you sell a subsidiary, you will receive cash. So in the consolidated financial, bank will be debited. Bank debited, and then you will cease to show NCI. So you will debit the NCI as well. NCI is equity. So it's a credit balance. In order to remove it, you will debit the NCI. Then you will credit the net assets in subsidiary. So net assets will be credited. And then there is one more credit, and that is the goodwill. So you won't carry any more the subsidiary's goodwill in the financial statements. And the last item will be the gain. If you receive more cash you will be recording the gain. The financial statement. So that's the gain, that's the entry. So these effects take place when you dispose of a subsidiary company. So now this question covers these effects. They are telling you to calculate the gain or loss. So let's check what the question says. What is the requirement first? Let's check it. See, the requirement is calculate the gain on disposal, which should have been shown in the consolidated financial. Now there are two types of gains, right? One is the gain in the individual financial statements, and one is the gain in the consolidated financial statements of the parent company. So they are asking about consolidated financial statements. What will be the gain in the consolidated financial statements? So the entry which I have made, this is for the consolidated financial statements, right? So now let's calculate the gain for this consolidated financial statements. Okay, so according to the question, let me tell you the important things regarding this entry which I made. First, I will calculate these items. First, I will calculate the NCI, net assets, goodwill, right? And bank, I know how much cash is received from the bank. Just watch what has happened. Read these two paragraphs, which I am highlighting right now. Please go through these two paragraphs. This one on 1st September 20x7 and this one. But just go through the first paragraph only. You will get the figures from there. Okay, students, let's start doing this question and calculating these figures. Let me first calculate the goodwill. So I'm first calculating goodwill. For goodwill, I need to know the investment amount, and the investment in the subsidiary is 19.2 million, the consideration paid. Then I have to add the NCI, fair value of NCI. So the fair value of NCI given at the time of acquisition was 4.9 million. This is all dollars in thousands. And then I will deduct fair value of net assets in order to arrive at the goodwill. So fair value of net assets have been given in the question on acquisition were 19,800. So I will deduct the fair value of net assets in order to arrive at the goodwill. So this gives me the goodwill. So what is goodwill? Goodwill is the excessive investment. So excess investment over the fair value of the investment. So fair value of the net assets. So net assets are 19,800, but the investment are greater than it by how much? This is by 4,300. So that's the goodwill. Now, next we need to know the non-controlling interest. So what will be the non-controlling interest? Let's calculate the non-controlling interest. So non-controlling interest on acquisition was fair value of NCI on acquisition, which will be same as the amount taken in the goodwill calculation, 4,900, right? Now what happens that as soon as the subsidiary company is acquired, and then with passage of time, its net assets increase, its profits increase. So NCI will also be having share in the subsidiary company's profits. So NCI's share will keep increasing. So NCI's profit share will add to the amount on the available on the acquisition, reported on the acquisition. So NCI's share in post acquisition profits of subsidiary. So now what are the post acquisition profits? See, in the question they say okay, the net assets now are 26.1 million, right? And earlier they were 19,800. So they have increased. So the increase amount is 6,300. The net assets have increased due to the profits. So out of this 6,300, the NCI's profit share of 20% will be taken. So parent is holding 80%, so the rest 20% goes to the NCI. So NCI was initially 4,900 and now 1,260 will be added to it, the profit share of NCI. So the NCI at the time of disposal is 4,900 plus 1,260. So it's 6,160. So now you arrive at two figures, the NCI and the goodwill. So now in order to calculate gain, let's use this entry. See what happens. Plug in the figures in this entry. It's easy to remember this entry because you can know that we have to credit the goodwill, remove the goodwill, so credited, remove the net assets, credited, right? Remove the NCI, debited, and bank, you receive cash, debit the bank. So how much amount was received in the bank? So in the first line of the paragraph we read, the subsidiary was sold for 28,640, 28.64 million, right? NCI was 6,160, debit. Then net assets were on the date of disposal, the net assets were 26,100. Plug into it, and the goodwill was 4,300. Now, the balancing figure is left behind. Just calculate the balancing figure. So the balancing amount is 28,640 plus 6160 minus 26,100 minus 4,300. This gives you a gain of 4,400. So that's how we calculate the gain. So that's the simple formula to calculate the gain on disposal of a subsidiary. Now, one more thing. This is the gain in consolidated financial statements. Now, parent will also be preparing an individual, its own financial statements. So in its own financial statements, gain in parents' standalone financial statements. So in parent standalone financial, they won't be consolidating the assets of subsidiary, right? In the standalone financial. So what will be happening there? They will be having the investment over there. Investment in shares will be reported in the standalone financial statements. And at what amount did they purchase those shares? And at what amount did they make the investment at the time of acquisition? So at the time of acquisition, they purchased the shares for how much amount? The investment amount was 19,200. This was the amount of investment. So now what happened? If you just assume that you are making the financial statements on standalone basis of the parent company, the Perkins company. So the investment will be reported over there at probably 19.2 million, and now they sell the shares for how much? 28,640. So what will be the gain in the standalone financial statements? So in standalone financial, they will credit the investment. They are not asked for this, but I'm just telling you something in excess. What will happen? They will debit the bank in the standalone financial statements. Debit the bank by the sale proceeds, which is 28,640, and they will credit the investment. So they purchase the investment for 19,200. Right now, what happens? There is a difference between the investment and the bank amount. So they recognize a gain in the standalone financial, which is difference between 28,640 and 19,200, which makes 9,440. About this, they have talked about in the question. If you look on the question, just check over here. How did this 9.44 million appear? This 9.44 million should have appeared in the standalone financial statements. But what the question says, okay, they have included this 9.44 million gain in the consolidated financial statements. So you have to correct the financial statements in order to remove this 9.44 million gain, right? Okay. So let's move on to the next requirement. Okay. Let's move on to the next requirement now. So the next requirement of the question is remove the results of Swanson company and the gain on disposal of the subsidiary to prepare a revised statement of profit or loss for the year ended 31st December 2007 for Perkins companies only. So you have to remove the effects of subsidiary companies and the gain on disposal. Right now, remember one thing, that what IFRS 5 says. According to IFRS 5, discontinued operations shall be shown separately. So now this operation, the Swanson's operations, have become a discontinued operation and they will be shown separately. So they should not have been consolidated. In this question, if you note, in this question, they have given you an income statement. Just check. This is the income statement over here. And this income statement for the current year is consolidated. So they have not separated the figures from here. The discontinued operation figures have not been separated from these figures. So you have to separate it and show the continuing operation separately, means the Perkins own operation separately, and the subsidiary operations after the net profits from the continuing operations, then we'll add separately to it. Now, if you note over here 2006, these figures are just pertaining to the individual Perkins figures. So are these comparable? Are these two comparable? These two are not comparable. First, you have to convert this into individual without the subsidiary figures, so that we can interpret from it and we can compare these for performance measurement purposes. So what they say, that remove the subsidiaries figures from it first. So we will remove the subsidiaries figures from it and then make a income statement for Perkins only. Yes, there is a question from me to calculate, to go through the gain in the parent's financial statements only. So I'll do it first and then move ahead. See, there's a simple thing in there. When the parent purchased the investment in subsidiary, what entry would he have made? He would have debited the investment in its standalone financial statements and credited bank at that time, right? Now, after some time when he sells it, what he will do? He will credit the investment. He has credited the investment. Then he gets some money, 28,640. So he debits the bank. So what's the difference between these two? The difference is the gain, which appears in the individual fund. Now in individual financial statements, he won't be consolidating these things, net assets, goodwill, and NCI, because these are the standalone financial statements. In standalone financial statements, he will only be having the investment in shares using IFRS 9, right? So did you get it? Okay, I hope you have got this point. Okay, now let's separate the figures first. So in order to separate the figures, you will need subsidiaries figures. So they have given you the subsidiaries figures over here. Just check. These are the subsidiaries figures. So these are the figures of Swanson company. And plus, there was an intercompany sale as well. And there is no unrealized profit, because all of the products sold to Swanson have been sold by Swanson to an external party, right? As they say, Swanson has sold all of these goods onto a third party. So there are no unrealized profits with the parent company. All the goods have been sold. Okay, so let me make the working. So I'm making adjusted financial statements, adjusted profit and loss, Perkins only. So we'll be having first sales in it. After sales, we'll be having cost of sales. We'll be having gross profit. And then we'll be having operating expenses. And then operating profit. And then finance cost. And then net profit. Or profit before tax, right? So let's make the adjustment, students. Sales. Now the consolidated sales was 46,220. Now you will deduct the 9-month sales of subsidiary company. Because the figures given are for the whole year. For the year ended, they have given the figures. So they have given the figures for the whole year, right? So consolidation wouldn't have continued after September, because in September they had sold the subsidiary company. So they wouldn't have consolidated after September, right? So after 1st September, they have stopped consolidation. So we are removing just results of 9 months. So remove the sales of 9 months of the subsidiary company. And plus, you know that when we consolidate, we remove the intercompany sales. So add that intercompany sales back, which was of 1 million intra group sales. So this gives you the separate sales now. So the separate sales is $38,220. Now this excludes the subsidiary sales and the consolidation adjustment. Same with the cost of sales. Cost of sales of the consolidated cost of sales was 23,980. So you will deduct the 9 months cost of sales. So the subsidiary company's cost of sales is 6,600. Multiply this by 9, divide by 12 to obtain the 9 months cost of sales. No, it's 1st September. Yes, okay. It's 1st September, so it's 8 upon 12. Sorry. Please note the date. It's 1st of September. The date of sale is 1st September. So the subsidiary company would have been consolidated for 8 months. So it's going to be 8 upon 12. Okay, I have taken it as 8 upon 12 only. By mistake, I have written 9 upon 12. The calculation is according to 8 upon 12 only. So it's 8 month sales, which I have removed from there. And now the cost of sales is 23,980 minus the subsidiary's cost of sales. And I won't make intercompany adjustment over here, because intercompany adjustment is made from the subsidiary companies, and we are making the parent company's financial statement. So this is the gross profit you get now. So we arrive at the gross profit. $38,220 minus $19,580. And then operating expenses. Okay, so let's move on to operating expense. So for operating expense, the consolidated operating expenses were 3.3 million, and I will deduct the 8 months operating expenses of subsidiary company, and the most important thing is that the gain was in operating expense. How was the gain in operating expense? The gain being in operating expense means, okay, expense is a debit balance and gain is an income, it is a credit balance. So the net of both was the expenses would have reduced due to the credit amount of 9440. So they have incorrectly credited the gain to the expenses. So now I am again removing it. So by removing the gain, how will I remove the gain? I will debit it. So I will increase the expenses by 9440. So I will add 9440 to that expenses amount. So now the expenses amount will be so now we get the operating profit. After the operating profit, we deduct the finance cost. Again, same with the finance cost. Out of the total finance cost, which is 960, if you deduct the subsidiary company's 8 months financial charges, which has been consolidated, so this gives you the profit before tax or the net profit. Now, this is all about the containing operations, so that we can compare with the previous year of the individual Perkins financial statements. Okay. Now, so we are done with the separation work now. Okay, so Let's move ahead, students. Now, interpretation is attached to this question. Usually, the interpretation portion is attached to the consolidation question, right? So you should be prepared to do the interpretation of the same question of which you will be giving the consolidation work, right? So let's do the interpretation work now. The next requirement is requirement C and requirement D. So what is asked in requirement C and D? So the things that have been asked in requirement C and D is calculate the equivalent ratios to those given. So what will be the equivalent ratios? So we have to calculate these ratios: the gross profit margin, the operating profit margin, and the interest cover. They have already calculated the last year's individual Perkins ratios, right? But the ratios given over here for 2007 are the consolidated ratios. We don't want this. We can't compare with this. We have to compare. We have to make a working through which we will calculate individual Perkins ratios. Now we are going to calculate the Perkins ratios. So Perkins ratios are to be calculated over here, individual. So we will calculate. So now we have made the income statement. Now we can easily do it. So we'll be calculating the Perkins ratios now. Okay. So let's do it. Let's calculate the equivalent ratios to those given for the Perkins companies 2007 based on the revised figures. So according to the requirement B, we'll be calculating the Perkins ratios. So let's begin. So gross profit margin, net operating profit margin, and the interest cover. These three are required. So gross profit margin will be 18,640 divided by the sales. Gross profit divided by sales. So the sales is 38,220 multiplied by 100. So this comes up to approximately 49%, but in two fractions if we take, this makes 48.77%. So if you compare with this, okay, let's do the comparison afterwards. Let's calculate the ratios first. Then operating profit margin will be, the operating profit is 7573 divided by the sales multiplied by 100. This makes 19.81%. And then the interest cover. So the interest cover is operating profit divided by the interest. So the operating profit is 7573 divided by the interest, which is 160. So students, please calculate the ratios and then just think a bit in your mind regarding the analysis, and I will start in 2 minutes time. I will start the analysis in 2 minutes time. Okay, I'm muting my voice for a 1 minute time, then I'll continue again. Okay, students, 1 more minute, and then you can analyze a bit of yourself, and then I will start. Okay, students, let me start with the analysis. Now look, let me show you one thing first. Just check over here. If you check this, if you put a check over here, calculate the gross profit margin from here. The gross profit over here, 13.5 minus 6.6 is approximately, the gross profit is 6.9. Let me tell you the most important thing first. Suppose a parent company sells a subsidiary company. So there should be some justification behind the sales, isn't it? So if we calculate a gross profit margin over here, the gross profit margin will be 6.9 divided by 13.5. So this Swanson company's gross profit margin is more than 50%. Agreed or not? The gross profit margin is around 51.1%. You can check. 6.9 divided by 13.5. So it is 51.11%. And if you note that Perkins owns gross profit margin. What is Perkins' own gross profit margin? Perkins' own gross profit margin is 48.77%. What do you say? Should they have sold it? Should they have sold this Swanson company who was having a better gross profit margin than Perkins? They shouldn't have. So there a question raises over here that they have sold a subsidiary whose gross profit margin was better than the Perkins itself. They should have retained that company. Secondly, if you check the operating profit of this company, this subsidiary company. Let me make a schedule as well down in the working. I'm making a schedule for it. Now, have you got my point? That it looks like that these people have made some mistake and they have sold a subsidiary company which was performing better. So which type of subsidiary company should be sold? Usually the subsidiary company that you will sell will be a type which will be making a loss and which you cannot manage. That type of company you will sell so that you can improve your performance. But over here you are selling a better company. So first, this is the question. Now further, there is a lot of analysis to be done on this, and I will be coming with the details. But first, let me tell you about the individual ratios of Swanson company first. So always calculate the subsidiaries company separate ratios first before you comment on that whether correctly the decision has been taken to sell the subsidiary company or not, right? So let me do it first. I'm preparing the ratios of calculating the ratios of subsidiary company as well. So what happened that subsidiary sales were 13,500. Its cost of sales was its gross profit was its operating expenses were 2,510, and the operating profits were 2. Students, you will get the presentation for the day 2, 3, and 4 by tomorrow, right? So some of the day 2 presentations have been given to you in the probably they have been given to you yesterday, but not all of the day 2 because it was not complete. That's why it was not given. By tomorrow you will be given the day 2, 3, and 4 presentations as well. Don't worry, right? Okay, now let's calculate the ratios, percentages of this standalone subsidiaries percentages. This is Swanson company's percentages. always remember not to compare unlike items. Like you cannot compare the consolidated with the single company. You have to compare the single with the single, right? So obviously you can compare the single with consolidate, saying that after purchasing a subsidiary company, the performance improved in the consolidated fund. But you also have to compare the subsidiary company's individual performance or the Perkins individual performance, right? That's also important because both of the companies should perform well. So both individual performance should be compared and the individual and consolidated should also be compared. Likewise over here, we have to compare the individual versus individual, and we have to compare the consolidated and individual as well. I will show you how. But before I go on to that, let me first evaluate whether the disposal was a right decision or not, right? So let's calculate the percentages. The gross profit margin of Swanson's is and the operating profit margin so students just check, compare these with the Perkins own ratios. What happens? Compare the Perkins gross profit margin with Swanson's. So it looked like that Swanson was a better company, and the operating profit margin is very high. See, 32.52%. And what was the 2006 figure of Perkins? It was 16.8%. Then what about 2007? If you compare the 2007 figures, then again Perkins is 48.7% and Swanson is 51.1. What about this operating profit margin? Again, this one is a lot better in comparison with 2006 and along with the 2007 figures of Perkins. So it looks like that they may have made some mistake, but it's not always like this. See, an important point which you can note over here is that when parent company acquires Samsung or the subsidiary company, what happens? The parent company starts providing many services at a lower rate. Like in this question, the intercompany sales were taking place at what margin? At 30%, isn't it? At 30% margin. But what is the gross profit margin of Perkins? It is 48%. So if Perkins sells products to external suppliers who are not related parties at 48%, then it is giving goods to Swanson. Yeah, it was giving goods to Swanson until it was in control at 30% margin. So why was Swanson's profit margin high? The Swanson's profit margin was high due to getting or obtaining goods from Perkins at subsidized rate, due to which the Perkins gross profit margin was falling and Swanson's gross profit margin was improving. Agreed or not? This was the main point. So apparently it looks like that Swanson's gross profit margins are high, but if the relationship the parent subsidiary relationship won't be there. In that case, the Swanson's profit may not have been, profit margin may not have been that much high, right? And Perkins' gross profit margin would have been higher. Why? Because of selling at lower profit margins to Swanson, their profit margins are remaining low. And now if they start selling at higher profit margins, like with the external parties, third parties, they will be earning more profit margins. Secondly, what about the operating profit margins? So what happens that when parent company acquires subsidiary companies, the subsidiaries start using facilities of parent company at either low cost or at either no cost, either no cost or either low cost. I'll be giving you some points in writing tomorrow also, so that how we will write that also you will come to know. But I'm just right now giving the briefings regarding the interpretation. So what happened that the Samson was obtaining other facilities, other facilities like rent. They were saving rent. You can note that over here they tell that once the parent lost control over subsidiary, the parent company has asked for rent to the subsidiary company. So the subsidiary company has paid 4 months rent to the parent company, because of which their operating profit margins would have increased. So from the next year onwards, subsidiary company will be paying rent for the full year. This means that earlier in past, when parent had control over subsidiary company, the subsidiary company was not paying any rents to the parent company. So it was enjoying the space facilities free of cost. That's why their profit margins may have been higher, as shown over here, right? So what's happening that subsidiary companies results are apparently better. One of the reasons behind that could be that they are obtaining goods and services and expenses at either low cost or at lower profit margins from at reduced cost from the parent company, due to which the profit margins of parent company are going down and the subsidiaries profit margin are improving. So in the upcoming years, it may happen that due to receiving rent and receiving services from parent company, the subsidiary company would have to pay properly at market prices. So their profit margins may go down and the parent's profit margins may increase, because the parent will be charging for all services from other companies or other third parties. Like Swanson will also become a unrelated party in the next year, because all of the shares are sold, right? So agreed? Have you got it? Got the points? Okay, students, that's all for today. I have explained the important points of the interpretation. I'll make you write it in the beginning of the tomorrow session, and tomorrow session will be going through further some interpretation work, some consolidation work, and then standalone financial statements as well. So see you tomorrow in the next class. Participants, thank you very much for attending the class from so far away. Let's finish it up and meet you tomorrow. Goodbye, good night, enjoy your practice work. Students, if you want an invite to the WhatsApp link, you will get the link tomorrow as well, or I will give you my number to you people. So you can then if you contact if you contact me personally, I will give you the link, right? So today's time is over. So you will be able to get it tomorrow.